Welcome back. In this episode, we are going to address the question, how do I pay less in tax during retirement? Well, in this episode, I'm going to show you my favorite vehicle that's totally tax-free, not just tax-deferred, but many people get trapped. And so I'm going to show you why that happens, because there's actually 4 different phases of retirement planning. And I'm going to show you what the most important phase is and how you can maybe cure a tax disease. See, the word disease means we're not at ease. And a lot of people, when they retire, are not at ease financially because of all the tax they start paying. So you ready to get immersed into some epiphanies? Here we go. My name's Doug Andrew, and I've been a retirement planning specialist for more than 45 years. And I'll never forget the day I was eating lunch with another financial advisor that I had trained, and we sat down on a napkin and we drew out these circles. There are actually 4 phases of retirement planning. The contribution phase, when we contribute money in these accounts for our future. It overlaps the accumulation phase, where hopefully our money's growing, right, with interest or dividends or whatever. And then we do this all for the day that we can take distributions or withdrawals. Too many people go into withdrawal when they hit this phase because of the amount of tax they start paying. And then none of us are getting out of here alive. I don't mean out of this room or out of this life. We're all going to die someday, and we usually leave behind something that would have sustained us had we lived longer. And if you leave money in a yet-to-be-taxed IRA or 401k, it's the worst place to leave money, and savvy CPAs will always agree with me. Don't leave money in an IRA or 401k when you die. But see, most, they just go, oh, you can just do the stretch IRA. So let's look at 5 different savings alternatives. If we were running $1 million dash, let's say, and our goal was to cross the finish line with $1 million net, our money after paying tax, everything like that. Most Americans are crawling around this racetrack in life with yet to be, with actually taxed as earned investments, where they pay tax on their money when they earn it, and they take after-tax money and put it into a bank or a credit union, and every year you get that interest statement, 1099 interest that comes in from here or there, and you have to pay tax on interest and dividends, and then any gains are taxed, and when you die it's taxed. Tax, 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 tax. It's all red circles. If you want to walk around the racetrack, you could maybe purchase like an annuity. An annuity means you're taking after-tax money and you're putting it into something that's going to be tax deferred. And then when you pull out the money, it's now taxable LIFO. Now, LIFO means last in, first out. So if I put in $500,000 and I was earning 10%, I'm earning $50,000, they're paying me $50,000 a year out of that annuity. It's all deemed the last money I'm earning, the interest is the first coming out. So it's all taxable until I reduce my principal. So that is like walking around the racetrack, and I can prove this mathematically, and it's taxed when you die. Now, when IRAs or 401ks came out, you could use pre-tax money or tax deduct what you put in, the seed money, and accumulated tax deferred. Oh, you'll be in a lower bracket when you retire is what they told us, right? Well, it's taxed when you take it out, and people are shocked how much that erodes away your purchasing power and the net spendable income. And when you die, it's taxed as it transfers, or you're not transferring it tax-free, it's tax deferred. As I've said in other episodes, when the Roth came out, a lot of people were savvy, and they said, let's just pay tax on the seed money we put in, the contribution phase, and let's accumulate it tax-free and access it tax-free. But I don't own a Roth. Never have, never will, because in other episodes I teach my favorite vehicle is a max-funded, tax-advantaged insurance contract under Section 101A of the Internal Revenue Code. I just call it the LASER Fund. LASER is an acronym that stands for Liquid Assets Safely Earning Returns. It spells that acronym LASER. It's laser-focused. It accumulates tax-free, but when I die, it blossoms in value, sometimes double, triple, and transfers tax-free. I can prove all day long 3 green circles is better than 2 green circles, but I like to have my cake and eat it too. So I like 4 green circles because that's like sprinting around the racetrack. So in all the educational books that I've written, the episodes that I hope you'll watch to get further insights, I'll show you why you want to have 3 green circles instead of 2, and why you don't necessarily want to put much money at all in an annuity. There's only maybe 1 or 2 annuities I would ever own if I did. But this is the way most people save. This is poor, okay? Fair, good, better, best. I want the best, don't you? So I would recommend you consider having 3 or 4 green circles by choosing the best alternatives that will be tax-free during the accumulation phase, during the access phase, the distribution, and also when you transfer it to those that you leave behind. What I have done for many, many years is helped people at retirement, because at retirement planning is way different than maybe what you did for retirement. If I were a physician, I often say that I spend more time curing people's tax disease. I wish I could have prevented it in the first place. So if you're watching this and you're feeling a little bit of pain because you've got money trapped in an IRA or 401k, thinking you were going to be in a lower tax bracket, there are episodes where I can show you how to free yourself from that tax trap, because I know exactly how you feel. And we've helped many, many clients save unnecessary tax, $250,000, $500,000. One couple I think of right now, they were both physicians, $1.2 million. We've done this thousands of times for people just like you. But here are the basic areas that we can avoid paying tax during retirement. And too many people are way too top heavy in the investment bucket, is what I call it, in yet to be taxed IRAs or 401ks, and it's in the market, and they shouldn't have more than 30% of their money there. So I had to do a strategic rollout to get their money out of this into the tax-free bucket. People use real estate, but I don't think all of your retirement income should be coming from just rental income or real estate, because frankly, many people get sick and tired of managing the property and taking out the trash and fixing the toilets. So maybe up to 30% here. This is where, unfortunately, 80 to 90% of people's money would be when they would come to me. Many times people want some guaranteed income, Social Security, defined benefit pension, but somewhere between 0 to 80% of your money could come from this bucket, and that would be done with a lifetime annuity that if you ran out of money at age 75, 80, 90, you won't run out of income if you live to be 120. But folks, this is where I have over 60% of my retirement income. It's in the tax-free bucket. This is where a lot of times I help people get the money out of here, the tax is over and done with, and put it into here, where it grows tax-free from now on. And when they ultimately pass away, it blossoms in value at reimbursing tax-free the taxes you paid getting it out of here down to here. And there's no other vehicle that does that except for what I call the laser fund. Municipal bonds are tax-free, but I've always earned in my laser fund at least 2 or 3% higher interest than a municipal bond, plus many municipalities aren't as safe as we think they are. They don't run those cities as well as maybe we thought. The Roth is a step in the right direction, but in another episode, I have explained that the laser fund is called the rich man's Roth. It has the 2 benefits of a Roth and 3 additional benefits Roths will never have. And so my favorite vehicle is the laser fund. Now, if you want to learn more about that, this is why I wrote the book, The Laser Fund. It's my 11th book, and it's actually 2 books in one. This front one here is comprised of about 200 chapters containing charts and graphs, 14 chapters at 3 levels of depth. If you're a right brain person, you learn by stories. You flip the book over this direction and you read about 100 pages here, comprised of 12 chapters with 62 actual client stories of how the laser fund is used for retirement, for tax-free income. It's used for college funding, business capital, emergency needs, estate planning, all kinds of goals, because it's the only vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free, access your money tax-free, and when you pass away, it blossoms and transfers income tax-free. So that's why the subtitle on here is How to Diversify and Create the Foundation for a Tax-Free Retirement. And if you would like, you can go to laserfund.com, just cover the shipping and handling, and I'll send you out a copy of that book absolutely free. It's actually 2 books in 1.